Bridging loans for property purchase and development. In general, bridging loans, from the term itself, bridge borrowers to a solution in cash flow issues. With the flexibility on its uses, bridging can be tapped for personal or business uses. In the context of commercial property financing, bridging is designed to pay off for the buyout of a new property, light refurbishments to massive property renovations, and the building of a property ground up. Bridging loans can provide fast cash, often in a week or within the day, depending on the case at hand. This financing option is also available where mortgages, which require that the property to be purchased are habitable by set standards, are not applicable. Loans for bridging can be repaid either via the resale of the property to be purchased or the liquidation of another property currently in the borrower's portfolio. Bridging is an excellent option when in need of quick access to cash to benefit from a business opportunity such as buying a property or land at a reduced market price, purchasing a property via auction, or acquiring a dilapidated property that can still be profitable after undergoing restoration works. How costly is it? As this means quick access to significant cash, the interest rates are expected to be at the high side compared to other property financing options such as mortgages, which usually levy interest rates averagely at 5% per annum. Bridging contracts usually run up to 2 years and are high in annual interest rate, which averagely reaches 1.5% per month or 18% annually, excluding other fees. Among the additional costs on top of interest are legal fees, arrangement fees, and broker fees if you would choose to tap a broker. Each service imposes a fee that ranges from 1% to 2%. How much can be borrowed? Bridging loan arrangements usually offer 70% to 75% of the property price, but this varies depending on the case. Higher-risk businesses such as gas stations may be given only as much as 50% to 60%, while a full loan-to-value deal can be availed on the condition that the borrower put up additional collateral. Most lenders can offer as much as over £1 million, depending on a borrower's case. What about repayment terms? Bridging offers two main types of repayment schemes: closed bridge and open bridge. Closed bridge. Lenders and borrowers set a date as to when the loan should be repaid. Open bridge. The borrower sets out a proposed exit plan to repay their loan, but no definite date is set. However, some lenders expect the full payment of a loan, including interest and fees, in a year. Most lenders are flexible enough to provide you with the option to pay your obligations on the usual monthly basis, on a rolled-up deal, or on retained interest. A rolled-up deal is a one-time payment made after the initial deposit and at the end of the contract. Some borrowers who are short on capital until their exit strategy usually opt for a rolled-up arrangement. As for loans set on retained interests, borrowers can choose to set aside the payment of the interest from the borrowed sum, whereas the interest charges may be paid on a more flexible basis, say, quarterly, depending on your lender, while the loan and amount will be paid on the regular monthly terms. How to be eligible? Most lenders are more welcoming to customers equipped with these: strong exit strategy, good credit history and experience in property development. Strong exit strategy. Exits refer to how you intend to clear the bridging obligations in full, including interest and other costs. In a bridging loan, you can either sell the property, place it on a mortgage, or resort to buy-to-let. Good credit history. As with several other financing facilities, lenders consider a borrower's credit profile as a reliable metric to determine your capability to clear your obligation. Experience in property development. Because of the high return that can yield from the property market, many, even inexperienced developers or investors, scramble to get a share of the sector's gains. Inexperienced borrowers, of course, have a higher chance of failing in their exit plans, in turn, defaulting on their debt. Although some lenders are open to newbies, the consideration is mostly on the condition that experienced brokers guide them. Provided a competitive and flexible finance package. All in all, would certainly do it this way again.